Everyone keeps arguing about tax rates like it's a blood sport. But what if the number you've been quoting in every debate is basically a polished lie? We're not talking about a rounding error here. We're talking about a fundamental gap between what the tax code says and what actually leaves your bank account. Let's back up for a second, because the whole system is built on two numbers that sound authoritative: your marginal rate and your effective rate. The marginal rate is the percentage you pay on your last dollar earned, and the effective rate is the average across everything, but neither one tells you what you actually surrendered to the government when all the smoke cleared. Think of it like a restaurant menu, where the prices look reasonable until you see the bill with service charges, taxes, and fees stacked on top. The marginal rate is the entree price, the effective rate is the subtotal, but nobody's showing you the full receipt. For decades, people argued about whether the rich pay their fair share by pointing at top marginal rates that once hit 90% in the 1950s and 60s. But economists quietly noted that virtually nobody paid those rates because the tax code was riddled with deductions, shelters, and loopholes that made the number largely theatrical. Here's where the mood shifts from academic to genuinely alarming. The metrics we still use today were designed in an era before carried interest, before pass-through entities, before opportunity zone deferral, and before the full architecture of modern wealth management existed. We're essentially measuring a Formula One race with a stopwatch designed for a horse and buggy. The psychological damage here is real. You file your return, see your effective rate, feel like you understand your burden, and then completely miss that your neighbor with the S-Corp, the depreciation schedule, and the health reimbursement arrangement paid a fraction of that on a much larger income. Studies from organizations like the Institute on Taxation and Economic Policy have repeatedly shown that when you fold in payroll taxes, state and local taxes, and consumption taxes, lower income households can face total effective burden rates that rival or exceed those of households earning 10 times as much. History keeps trying to teach us this lesson, and we keep skipping class. The Tax Reform Act of 1986 was supposed to simplify everything, collapse the brackets, and eliminate shelters. And for about a decade, the system was arguably more transparent. Then the complexity crept back in. Layer by layer, credit by credit, carve out by carve out, until we ended up with a code that runs to millions of words and requires an entire professional industry just to navigate. Here's the broader cycle you need to see. Every generation rediscovers that tax complexity is a feature, not a bug. Because complexity disproportionately rewards those with the resources to exploit it. The community of tax professionals, CPAs, and financial planners will tell you privately that their most valuable clients aren't the ones with the highest incomes. They're the ones with the most complicated structures, because that's where the savings live. Let's kill a misconception right now, because this one causes real harm. A higher marginal rate does not automatically mean a higher tax burden, and a lower headline rate does not mean you're keeping more money. What actually determines your outcome is your taxable income, after all adjustments, deductions, and credits. And that number can be engineered dramatically by people who know what they're doing. So what do you actually do with this? You stop optimizing for a metric and start optimizing for an outcome, specifically your total after-tax, after-cost cash position. That means understanding your full tax picture, including self-employment taxes, net investment income taxes, state-level exposure, and the timing of income recognition, not just circling a percentage on a rate table and calling it a day. The practical lesson from every tax cycle since the modern income tax began in 1913 is this: the people who build wealth don't fight the rate. They engineer their relationship to the base. Disciplined entity structure, strategic timing of income and deductions, and consistent use of tax advantage vehicles matter infinitely more than your emotional reaction to whatever the top bracket happens to be this year. At the philosophical level, the rate was always a distraction. What matters is the system you build around your income, year after year, with patience and consistency, regardless of which party controls Congress. Conviction about fairness is fine for dinner parties, but process and positioning are what actually protect and grow your wealth across decades. The beautiful and slightly absurd irony is that the people most loudly debating effective versus marginal rates are often the ones paying the most because they never built the structure to do anything else. You don't have to be in that group. And understanding that these metrics are incomplete is honestly the first step towards something better. And if any of this is making you think about how your real estate investments, your business income, or your property decisions fit into your actual tax picture, that's exactly the kind of thinking we help people act on. Check out our links in the description below to get started, whether you're exploring real estate investing, need contracting work done, or want to connect with lenders who understand how the full picture works.